Insurance isn't exciting until the day it saves your entire life and wealth plan. If you're a high earner or on your way, insurance isn't just a bill, it's wealth protection. Today, I'm talking about the coverages people overlook, how to shop without getting overwhelmed, and the simple annual review routine that keeps you protected without turning your life into a paperwork hobby.
Yeah. Building life away.
What's happening, my wealth holders in training? Welcome back to another episode of the Do Different Better show, where we talk wealth wisdom and money moves for everyday people. I'm your host, Elaine Rasmussen, your wealth alignment coach and legacy building BFF. Today's episode is called Soft Life, Hard Reality: Three Ways the Wealthy Protect Legacy. And I know, insurance is not sexy. And it's definitely not the episode you asked for, but it's actually the episode I know you need. Because insurance is one of those things that you don't care about until the day you really care about it. And then it's actually too late. You wish you had gotten it. And here's the main idea: insurance actually isn't a bill. It's actually a wealth protection strategy. And the wealthy have been using it to, guess what? Protect their wealth. Insurance protects your ability to keep building your income and your assets and your lifestyle and your family. And it does that for anybody. You don't have to necessarily be wealthy. And for my high capacity people, like these are leaders, these are entrepreneurs, these are caretakers, high earners, they are especially vulnerable because your life runs on momentum. You have all these responsibilities, you have all these fixed costs, and people depending on you. A disruption doesn't just slow you down, it cascades to everyone around you. So if you've been treating insurance like annoying paperwork, or you'll get around to it at some point, well, today we're changing all of that. Now, I could spend all day talking about all the different kinds of insurance, but I know I'll definitely put you to sleep. But you know me, I'm going to keep it practical and tactical. We're going to focus on the coverages that most often get overlooked. And that's three. We're going to talk about disability insurance, umbrella liability, and term life insurance. You may have seen these phrases kicked around on late night commercials, but also I'm going to show you how to shop for it without getting overwhelmed and how to review it annually. So let's start with the most important wealth protection question that very few people ask. That is, what is your most valuable asset right now? And for people listening, you might be thinking, oh, it's my house. Or you might be thinking, oh, it's my car. But I'll tell you, it's not even your retirement account. It's actually your income, your ability to earn. Your income is the engine that funds your baseline, builds your buffer, and grows your brick house. And it's what allows you to actually invest. If that engine stops, everything feels completely different. And this is why it's wild that people insure their phones and their cars way more easily than they insure their income. So let's talk about the coverage and the most high capacity people ignore until it's too late. The first one is disability insurance. It's what I like to call the unsexy MVP of insurance. Disability insurance is wealth protection because it covers the risk that you can't work due to an injury or illness or someone else's injury or illness. And before your brain begins to negotiate or argue with me, this isn't about catastrophic events, right? A lot of disability claims are for things that happen to normal, everyday humans all the time. This could be you're out of work because due to back issues, you have a major surgery, you have a chronic illness, maybe it's mental health, maybe it's complications that you didn't actually plan for. And here's the problem: many people assume employer disability is enough. And many times and often enough, it is actually not. Employer coverage can have gaps. It may replace a smaller percentage of your income than you actually think. It also may cap benefits, especially for high earners. It may have definitions that make it harder for you to qualify to actually take advantage of it. And if you leave the job, more often than not, it doesn't follow you. So here are two phrases that matter a lot in disability policies. The first is own occupation versus any occupation. Own occupation generally means if you can't do your job, you qualify. Any occupation means if you can't do any job, you might not qualify. It's a big, huge difference. Also, you have to look at elimination periods and the benefit period. The elimination period is how long you wait before benefits kick in, sometimes like 90 days. Maybe it's longer, maybe it's shorter. Then you also want to look at the benefit period, which is how long it pays. Does it pay for 30 days, 2 years, 5 years, or all the way into retirement age? Now, connect this to your money backbone framework, right? Your buffer should cover your elimination period. If your elimination period is 90 days, do you have enough buffer to cover 3 months of your baseline? If not, you're relying on luck. Your brick house is what protects you from long tail events and long recovery time. Disability is the policy that protects your income engine so you can keep building wealth even when life gets super real. Okay. Now, if you hear nothing else from me today, I want you to hear this. If you don't insure your income, you don't fully protect your wealth plan. Point blank, period. Right? Now, here's coverage number two. Coverage number two is umbrella liability. The I'm not that kind of person policy, right? Umbrella insurance is liability coverage that sits on top of your auto and your home policies. People skip it because it sounds like something that's for rich people with yachts and luxury homes and things like that. But that's not what it's for. Umbrella protects you from large liability claims that can happen to normal households. This is something as incidental as a serious car accident where you're at fault. I know for somebody living in Minnesota, it can happen at any moment in time. I think I shared with you a couple of months ago, I was coming down a hill that we had just had a big major snowfall. The ice had compacted and slid right down that hill and into another car. No fault of my own, but that could have been a very devastating thing, not only for me, but also the other person. With disability insurance, it would have helped me manage any time off that I may have had to have, and any additional, like, protects me in possibilities where things where I may have put somebody else in danger as a result. If someone gets injured on your property, like while doing renovations to your home, teen drivers, certain social host situations, if you host a wedding at your party or a big dinner party and something happens, maybe something catches on fire or somebody falls and breaks a leg, the umbrella policy can help. This also, umbrella policies help with lawsuits that come with having a lot of assets and income. Because we all know people tend to put a target on your back if you have more assets than most people. So here's the simple truth: the more you have, the more you have to lose. This is a math problem, right? Umbrella is about protecting your assets and future income from worst case situations or liability. And here's why high capacity people need to pay attention to this. If you are building assets, investments, home equity, you're building business value, your exposure automatically starts to grow, but your umbrella can grow with you. Now, here's coverage number three that I'm going to cover: term life insurance. That is income replacement, not an investment. Okay. Term life is there to protect people who depend on you. So think about if you have kids, if you have a spouse or a partner who relies on your income, debts that would be a burden in your household if you were to lose your income, or other caregiving responsibilities. Maybe you have a somebody, you are a guardian for somebody who has some longer term health issues that require your caretaking. Term life is not necessarily optional, it's actually protection. Term life insurance answers, if something happens to me, can the people I love maintain their baseline? Can they avoid panic decisions? Can they keep the house and stay in the house? Can they pay bills? Can they fund childcare? Keep life stable. And I'm going to say this plainly because there is some common confusion. Term life is not an investment. Although some people talk about it that way, it's what I like to call a risk transfer tool. You're buying protection for a season in your life while people rely on you. If you're single with no dependents, life insurance may be less urgent for you. But if you have dependents, it could be a cornerstone of your wealth plan and wealth protection and asset protection. Now let's talk about high capacity people still miss these coverages and why they miss these coverages. Because it's not just ignorance, it's a pattern linked to your wealth identity, right? So let's talk about your wealth identity and as it relates to this conversation. So for my builders, you can overbuy complexity. You might have too many writers or too many add ons or too much customization to your insurance plan when all you need is something like basic. For my builder fix, I want you to think about protecting catastrophic risk first. Keep it simple and keep it clean. For my caretakers, you tend to underinsure yourself while protecting everyone else. You've got policies on everyone else, and maybe you don't have a policy on yourself, right? The caretaker fix is your household stability comes first. Your income is the infrastructure. For maximizers, you like to DIY too hard, research forever, and maybe delay or never make a decision. So here's a fix for you: set a deadline, pick 2 to 3 options, and rules beat your research spirals. Create rules by which you will make decisions and then do them. For my minimalist strategies, you tend to avoid paperwork and auto renew and overpay by default. So here's the fix I have for you. I want you to set one annual review date, set up one folder, and one checklist. This is wealth capacity in action. Insurance is hard. It's not hard, but it is complicated. It's hard because it's an admin, and high capacity people are already carrying too much admin in their lives or a lot of admin in their lives. So here's the reframe we'll use for the rest of this episode. Insurance is not a hobby, it's a routine. You don't think about it daily. You set it up well, then you can review it on a schedule. So I want you to think about all that I've talked about and breaking down some of these, the 3 main insurance policies that you can think about. Like I said, there's so many different types of insurance policies. I just want you to think about these and as it relates to where you are in your life right now, where you are in your wealth building journey or your wealth plan, and what might be resonating for you. Now, coming up in the next segment, I'm going to give you a simple shop without overwhelm method. It's going to tell you what you need to gather, what you need to compare, and what you can actually maybe not put too much attention to or even possibly ignore. Because most people don't need more insurance content. They actually need fewer decisions and a very clean process by which they want to do this or engage in this activity. You're listening to the Do Different Better show. I hope you're catching us on Sundays on AM 950. I'm your host, Elaine Rasmussen, and I can't wait to see you after the break.
Yeah. So they might go right to, hey.
Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. And we've just spent the first segment talking about the different types of insurance. And if you're new and you've been putting it off and you were like, hey, I can't even think about what kinds of insurance or having a conversation about insurance because it's too overwhelming, that's okay. I just spent the first segment breaking it down of just starting with the first three particular ones that you can look at and think about and give you something to get your foot wet, get your feet wet and get started. So now that we've talked about what the three wealth protection levers that are used by the wealthy are, now it's about how to shop without making insurance feel like you've just binged in the entire Law and Order anthology. Because the reason people avoid insurance is not because they don't care. I know that you care. It can be just really overwhelming. It's because shopping for insurance feels like a maze of jargon, fear of making the wrong decision with an extra dose of a lot of sales pressure, right? And some of us just don't deal well with that salespersony kind of hard sell, right? We don't know how to regulate our emotions and be able to participate in that conversation and say, "Hey, slow down. I don't know what you're talking about." So, I'm going to give you a simple method that works even if you hate paperwork. Okay. I call it the 30-minute insurance method. Before we do steps, I want you to understand a core underlying principle, right? What we're doing is we're insuring catastrophes and we don't overpay to insure inconveniences. Those are not the same thing. A lot of people are overinsured on the small stuff and underinsured on the stuff that would actually wreck them. So think about people insure their phones. That might be $1,000, $1,200 investment, but they don't insure their life. All right. I think your life is far more important than the phone. People will insure their car. Again, maybe that's a 20, 40, $50,000 investment, but they don't really think about what happens if I lose my job and increasing the amount of disability insurance that they have. So we are going to we're going to sort insurance decisions into three buckets, trying to keep it super, super simple. Bucket number one is catastrophe coverage. These are things that it's a must have. This is the stuff that actually protects your wealth plan. So, once again, disability income coverage. This is adequate liability, including an possibly an umbrella policy for many of you. This is term life, particularly if you have dependents. It also is looking at appropriate health coverage for major events and home and auto liability at sensible limits that make sense, right? For example, getting your car insurance and having like a $2,000 deductible when you know that you don't have $2,000 of discretionary income from month to month and you don't have a buffer buildup, that's probably not the kind of coverage that you need. So that's just an example of what I'm talking about. Now, here's bucket number two. This is the convenience coverage. This is optional, right? And I particularly ask people to think about this coverage after you've already done some of the baseline stuff to create some sustainability or a foundation. These are features that reduce hassle, but they tend to be more expensive. This could be having very low deductibles, right? A $500 deductible or $250 deductible, or maybe a $0 deductible as it relates to when you think about car insurance. These could be extra riders that cover smaller annoyances. Those come at a cost. And is that really what you need, or is that just to make you feel better? And other add ons that duplicate coverage that you might already have. Now there's bucket number three, and that's duplication. This is where we see waste. This is where you're paying twice for the same risk because you don't even know what you have. You don't have to get all of these all at once. I actually discourage it because you really want to think about what's happening in your life. What do you anticipate happening in your life, like in the next 3 to 5 years? And letting that inform where you start and how much you get. I actually discourage you from doing everything all at once. But what I do want you to do is I want you to get started. Now, let's step in and lean into the process. Step number one, we're going to build an insurance packet. This is a single place. This could be a digital folder or a binder where all of your policies live. And I'm not just talking about the ones that we're talking about today. Did you know your credit card may have some of these policies available to you, if not embedded in the having the card that you can buy in addition to as an add-on to your credit card. So I want you to download your credit card statement. And if you are using AI, put your credit card statement or your terms and conditions into or your benefits of your credit card into ChatGPT and to have it give you a quick bullet point of what are all the coverages and what are the amounts of the coverages. Um, I know that many credit cards have travel insurance, many credit cards have disability insurance. So you might have coverage that you don't even know that you have, right? So, but here are the documents that you are going to gather. You're going to gather the declaration pages for all of your insurance policies that you know of. So these are maybe your auto insurance policy. If you are renting, it'll be your renter's insurance policy. If you own a home or you have a rental property, it'll be those. If you have any insurance of any of the assets that you own, I want you to get those declaration pages. If you don't already have them, you can request them. You go to the website of the particular asset, the company, and you can request that if you don't. Or usually they'll email it to you, especially once a year. It might even come with your annual year-to-date statement, your annual summary statement. It might come with that as well. But you're going to get your declarations page for all of your policies. If you have a disability policy, I want you to get the information of the employer and the individual representative if you have it. For your life insurance policy, I want you to grab that information as well. If you already have an umbrella policy, you want to grab that. And you want to get your health plan summary. Again, if you don't know where this is, you can go to your HR department at your work and ask them for a copy of that. But nowadays, many times you have an online login to your health policy, so you can be able to just literally go to the website and download it. Okay. Now, this is all going to live in a folder. If you want to print, if you're old school, you can print them out and put them into a binder. I definitely encourage you to do both. Having them hard copy printed, but also having them digital. The great thing about having them digital, again, you can leverage AI to put those in there and be like, hey, I am I am taking on Elaine's method, and I want to know where are the gaps based on I'm trying to build a buffer and a baseline and a brick house. What am I covered for? And where do you see are the gaps? It's a very powerful tool because I don't know about you, I'm not reading 10 pages of 3-point font writing. Okay. So, again, the goal of this is not to get you to read all of these pages, but if you want to nerd out, have at it over your Sunday morning coffee. Go for it, right? But what you are doing is collecting the at a glance pages that show your coverage limits, your deductibles, your premiums, your policy numbers, and your renewal dates. These are the pieces of information that only you will need. But if for some reason you're incapacitated, your key person who is going to be managing your wealth plan or your life or your financial businesses, they're going to need that information as well. So you may even want to put all those 5 pieces of information into a spreadsheet or write it on a document. This folder is the difference between feeling overwhelmed and actually being organized. Okay, let's move into step 2. Decide your comparison metrics before you get quotes, right? Not after. It'll just drive you crazy if you try to do it afterwards. Shopping fails because people compare premiums only, but premiums are not the only and the whole story. Each For each policy type, you need to pick some key metrics that are valuable and important to you. Here are some that you may want to consider. If you're looking at home, auto, or renter's insurance, you might want to look at what are the limits of the liability? What are they going to actually cover if something happens? What are the deductible amounts? What are the replacement costs versus the actual cash value for the asset that it's going to replace? What are the exclusions? Because exclusions matter. Bundling discounts. This is only if the base premiums are competitive to other ones. Now, let's talk about disability, right? So, again, we talked about defining own occupation or any occupation. Will you pay out if I can't do my job? Or will you not pay out if I can't do, or will you pay out if I can't do any job? You want to know because that could make a difference depending on the type of work you do. If you're an accountant and your insurance in the policy says you have own occupation, meaning I have broken my wrist skiing and I can't type on a typewriter or do my job, and so you want to make sure your policy covers that. But if it says any occupation, well, it's going to say to you, well, you could be online customer service, you can be a podcast narrator, or a audio a book reader. Is that what you want to do? So once again, making sure that you understand, is it own occupied or any occupation when it pays out? What is the amount? And is there a cap on the amount? Maybe the cap is at $500,000. Well, if you're a high earner and that's a half a year of salary or 1 year of salary, then you might want to look at upping the amount, the benefit amount. What's the elimination period? What's the benefit period? Is it portable? Can I take it to another job if I decide to leave this job? A lot of times they're not. So you want to make sure that you understand that, and you want to understand if there are any exclusions or limitations. And then with term life, you want to look at what is the length of time. Often it's 20 to 30 years, and that depends on whether or not there are dependents. But you also want to look at the coverage amount. Is this enough to replace my income or at least cover my major obligations? You want to look at whether it's a level term, and how are the beneficiaries updated, and can you update your beneficiaries? Sometimes you can only put in the beneficiaries at the time that you sign the policy. Well, your life may change. Maybe you get divorced. Maybe your life situation changes. You get married. You want to be able to make those changes. So does the policy restrict you from only assigning beneficiaries at the signing of the policy, or you can make changes someplace in the future? And then finally, looking at umbrella. So you want to look at, what are the coverage limits? Are you required, is required underlying liability limits, and what's included and what's excluded. And that can vary from company to company and policy to policy. When you decide what metrics matter to you, that are important to you, then you can shop without getting emotionally manipulated by a low premium that has weak coverage, or a very persistent salesperson. Now, here's step 3. You're only going to get 2 or 3 quotes max. This is important. It matters. If you get 9 quotes, I'm going to tell you what's going to happen. You're either going to avoid this decision altogether, or you're just going to go eeny, meeny, miny, mo. And that is not how we do things around here, okay? Both are worse than choosing from 2 to 3 solid options, right? And here's the thing. There are 2 ways that you can shop. You can shop with an independent broker. This is really good if you want to really have somebody else do the comparing. But again, you've got to understand and identify what's important to you, those metrics, but also what are you trying to plan for, and how much are you trying to plan for? And that's looking at how much, if I were out of work for a year, that might be the minimum coverage that you need to look for, right? The other option is to look for direct carriers. And this is fine, particularly if you really, really know what you want. Sometimes with these brokers, they're really good because they'll start to ask you these questions, because that's going to help guide them in identifying what are the policy or policies that are going to be optimal for you. But here's the thing. You're only going to pick one path, not both at once. Now, for step 4, you're going to calibrate deductibles based on your buffer and your brick house, right? And this is where the framework actually matters. People raise deductibles to lower premiums. Then they don't have cash to pay the deductible when something actually happens. That's not efficiency. That's actually financial fragility. So here's the rule. If your buffer can comfortably cover the deductible, consider a higher deductible to get lower premiums. If your buffer is already thin, then don't raise the deductibles just to feel optimized, right? Your deductible is a cash flow event. It must match your cash reality, your current capacity, right? Also, disability elimination period. It's got to be able to cover that. If benefits start after 90 days, your buffer and your brick house strategy need to cover the gap, right? That's how the system fits together. The whole financial system fits together. And now, step 5, avoid the 3 shopping traps. Trap number 1, premium only shopping. Low premium can hide deductibles, exclusions, or inadequate liability limits or coverage that might be important for where you are in your particular life stage or where you live, right? Could be geographic. Trap number two, buying every add on because you're feeling anxious. Anxiety makes people overbuy and strategy or enact, not do anything. Strategy buys with what protects catastrophic risk first. Trap number three, avoidance disguises research. If you've been researching insurance for a month, you're not actually researching. You're avoiding the discomfort of actually making a decision. So here's what I want you to do: set a deadline, pick one, and move on. You can always analyze it next year when you do your annual review, which we'll talk about later. Now I'm going to give you a fast decision filter that you can use today, and it's a 3-question filter. You know, I like to keep it simple for you. For any policy decision, ask yourself, what catastrophe does this protect against? 2, if that catastrophe happened, would it break my baseline or drain my buffer or threaten my brick house? Number 3, is this the simplest coverage that solves that problem? If you can't answer question 1, you're likely buying convenience or duplication. Now, before getting into the last segment, I want to address the mental part of overwhelm because I understand, I get it. Insurance overwhelm often comes from thinking you have to solve everything all at once, and you don't. So here's the order I recommend for particularly high capacity people who already have a lot on their plate. They're already juggling a lot. Number 1, confirm your disability coverage. That's your income, right? Check with your employer, and yes, check your credit cards. Your credit cards, yes, sometimes may carry disability coverage. Number 2, confirm liability limits and umbrella. Protect your assets and your future income. Number 3, confirm your term life. If you have dependents, you want to protect your household baseline. And number 4, optimize your home, auto, and health details. And remember, you're not trying to build the perfect policy. You're trying to build a system that protects your wealth plan and your family. And if you're just tuning in, we've just covered the 30-minute insurance method, how to shop for insurance, and how to decide where you should begin. And if you have no idea where to start, we've covered that. Coming up next, I'm going to get into the annual routine. What is it? When to review it? And what life events should trigger an immediate update? That's how you stop being underinsured or overpaying by accident. You're listening to the Do Different Better show. I'm your host, Elaine Rasmussen, and I will see you after the break.
Yeah. So they might go ways to pay
Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. If you're just joining, I've been talking about leveraging one of the most powerful wealth protection tools used by the wealthy and how you can do it too. We've covered the types of insurance to leverage, where to start, how to shop using my 30-minute insurance method. Now, in this last segment, it's all about the system because insurance works best when you actually review it before you need it. Now, here's my promise: you can maintain effective insurance with one annual routine, plus a few life event triggers, right? Because life be life, and that's okay. You don't have to think about it all year long, right? So, we're going to put insurance on your wealth calendar like any other adult responsibility. It's going to be boring, but it's consistent and it's protective. Now, here is the annual insurance review. We're going to do this once a year, and it's going to take 45 minutes. You're going to put this on the calendar, put it on your calendar right now. Pick one month every year, and typically it should be the same month, and put it on your calendar. It's a date with yourself, it's a financial date with yourself. I recommend a month that isn't already chaotic. So don't choose the month where there's 3 birthdays. Don't choose the month where you know it's the family reunion every single year. That's probably not a good time. So not the same week as taxes if you know that you're already going to be stressed. The annual review has 8 key check-ins to make sure your current lifestyle and needs are aligned with the coverage and plans you already have, and help you identify where there might be some coverage gaps that need to be filled. So here they are. Number 1, you're going to look at your coverage limits. Here's the question you're going to ask. Do my liability limits match my life today? If your income and assets have grown, then your exposure has also grown. Underinsuring liability is a common high earner mistake, and it's often done without them even realizing it. Number 2, you're going to look at your deductibles and you're going to ask, can your buffer cover them comfortably? If not, either lower the deductibles or build a buffer so your plan isn't fake. It's actually real and you're building it in real time. Number 3, disability coverage. I want you to do a review. How much income is actually replaced? Get the actual dollar amount. Find out whether your employer coverage is capped at a certain amount. I want you to find out and get a definition of, is it own occupied or any occupation? I want you to find out what the elimination period is versus what your buffer and brick house reality is, and the benefit period. So going back to your elimination period, if the elimination period is 90 days, but your buffer is only set up for 1 month, that's where you have a gap and you've got to figure out, okay, I got to prioritize building up this buffer because if something happens, they're not going to pay. My policy isn't going to pay for 90 days. So I need to start building towards getting that 90-day buffer. So in case something happens, I can trip the trigger of my disability insurance, and I've got that 3 months of income covered through my buffer. All right. And then again, look at the benefit period. How long is it and for what length of time? If your income increased, your coverage may not be enough. Okay. Number 4, looking at your umbrella policy. Confirm if you have confirm you have it and it's appropriate, and confirm the underlying required limits of the policy. Umbrella policy is only as good as the base policies underneath it. All right. Now, number 5, term life. And this is really if you have dependents, for something for you to consider. So here's some questions you want to look at. Is the coverage still appropriate for your income and the obligations that you currently have? Are the beneficiaries correct? Has someone passed? Has someone come into your life? These are things where this is the time where you're going to, oh yeah, that's right. Let me modify my beneficiaries or update my beneficiaries. Do you need more or less as your kids age and debts change, right? You might need less as your kids graduate college or they go off and they get partners and now they have they're well taken care of as far as they've got a good job, they have their own set of insurance. Maybe you don't need to necessarily carry as much for them as you used to. Number 6 is your health plan strategy. I want you to confirm the deductible and out of pocket maximum. And once again, does that align with your buffer and your brick house? You're going to find out whether your plan still matches your usage. And then you're going to look at if you've got HSA or FSA, so a health saving plan or a flex saving plan. Find out if that approach is actually applicable to you. Does it still work for you? Because it may not anymore. You may not need it. You may have had the HSA because your kid had braces. Well, your kid's braces are off now. So can you take that money and put it into some other pre-tax opportunity, or leverage that amount that you were putting into that into buying more coverage or expanding some other kind of wealth building leverage? You're not trying to win health insurance. You're trying to avoid financial surprise. That's the goal. And number 7, the premium creep. If your premiums jumped material, so this is actually another opportunity for you to check, has your premium increased from last year to this year, right? This is really important because if you're not paying attention, you can see hundreds or maybe thousands of dollars go down the drain because you're just not paying attention. and going down the drain because they're going towards a policy that's not relevant or meaningful for you, and you can't get that money back. Now, if your premiums have jumped materially, don't just accept it, shop it. Use the 2 to 3 quote method I talked about earlier in the show. And this is where minimalist strategists lose money because they're auto renewing forever and they never check this stuff. And number 8, this is documentation and access. Asking yourself, can someone find your policies relatively quickly if they need it? If you've got your policies on a digital folder that's got 24-bit encryption, it's not really accessible, right? So if something happens to you, you are incapacitated in any way, can your partner or a trusted person access what they need, right? You might be in a place where they need to get that information to a hospital or some other caretaker to be able to make sure that you are not in a financial bind as it relates to expenses related to the situation. If you haven't told them where and how to access these documents, tell them. I know this is unsexy, but this is actually this is an act of love, of letting them know where these things are. Now, that's your annual checklist, right? Those are the 8 items you are going to check annually. But there are some changes that could trigger an immediate review. These are what I call life event triggers. This is when no matter where you are in the year, you need to check them, right? Maybe you've just checked them about 3 months ago, but you've had one of these events happen. I want you, if you've had one of these major life event happens, you need to schedule a review within 30 days of the event happening, which means you might need to put it on the calendar. But here are some examples of some life event triggers that I recommend that you actually put on the calendar to review your policies. You've had a marriage or you've had a divorce. You have a new baby or an adoption. You have kids transitioning into becoming teen drivers. You're buying a home or doing major renovations. You're starting or scaling a business or a side hustle. You have a large income increase, or maybe you've received an inheritance or gotten new assets. Maybe you're moving to a different state. Maybe you have a major health diagnosis or a medical change. Maybe you're adding employees or contractors to your business, particularly if you're an LLC, right? Life changes create risk changes. Insurance should follow your life. Now, let's connect this back to your baseline, buffer, and brick house framework, because this is where people can sometimes get things kind of mucked up, right? So, let's talk about your baseline. Premiums are recurring. If your premiums strain your baseline, you might need to shop or restructure, not ignore them. Premiums should be affordable and predictable. If they're not, you're actually carrying hidden stress, which might cause you more anxiety, which might cause you to make bad decisions. Buffer. Your buffer should cover your deductibles, your out of pocket maximum exposure, your short term disruptions, your disability elimination periods, and also just making sure that all of those things are covered. If you can't cover your deductible, your coverage becomes a crisis moment as opposed to the crisis being the crisis moment. Now, dealing with your brick house. Your brick house is your long term stabilizer. Your brick house, remember, covers if you lose your job for 3 to 6 months. It covers long recovery periods. Let's say you got some medical procedure and you're out longer than you anticipated. It also covers your multi month income interruption and long tail life disruptions, right? Maybe you have to caretake for a child that's had a medical emergency. Whatever the case may be is, insurance plus your brick house is what turns disaster into disruption. And here's the biggest mindset shift. Insurance is not necessarily about expecting bad things. Insurance is about refusing to let one event destroy years of progress or your future. Now, I'll give you my simple do this week action step. So this episode doesn't become information you liked, but you didn't use. So here's the 3-step wealth protection move. Step 1, create your insurance packet folder. You're going to put everything in one place, whether that's digitally or physically. I recommend both. Step two, identify your missing coverage, most likely in the disability and umbrella policy area. Step three, put the annual review on your calendar right now. Right now, unless you're driving. Don't do it right now while you're driving. If you want one quick win that often saves money immediately, call your auto or home insurance carrier and ask for any current discounts you may not already be getting, whether bundling is still the best deal, and what the premium impact is for making adjustments on your deductible. For me, the insurance pilot carrier that I have, I can do all of that online. I don't need to call somebody. So you might want to check that out, especially if you've got phone anxiety. Go online and see if you can figure that out on your own. And then you can just confirm it. They might have a chat feature you can do that with. And then when you actually have a phone call with somebody, you're really only having to ask about one clarifying question. Then I want you to compare one independent broker quote, one, not eight. Okay, let's close with the truth that high capacity people need to internalize. You don't need to build wealth only by making money. You build wealth by protecting what you're already building. And yes, insurance is not sexy, but it is one of the most powerful forms of quiet wealth protection that you can implement. And if you don't believe me, talk to a wealthy person. They will tell you the same. So, if you're building optionality, if you're moving from flow to stock, if you're serious about your future, treat insurance like the wealth strategy that it is. Turn income into optionality. And this is how you do different better. Thank you for listening to the show. I'm your host, Elaine Rasmussen. You're listening to the Do Different Better show. Again, catch me on Instagram at Do Better with Elaine. You can also check out my YouTube channel at Do Different Better. And make sure you check out the website, www.dodifferentbetter.com, where I have lots of resources and templates that you can use. And you can catch up on other episodes, but you can find the show on your favorite podcast station. I'll see you next week and let me know how it's coming out. I can't wait to see you next week when I show you how to do different better.
Excellent. And there we go.